Right. We started the show today talking a lot about the mid-tier banks, how they have been buzzing. And in fact, we're going to now be touching base with one of those buzzers, the top management of City Union Bank, the managing director and CEO, Mr. Kamakodi, live with us right here on the show today. So, Kamakodi, the question to also ask is that, the stock's been buzzing, post a solid set of results. What, in the sense, what do you think was the concern areas and what were the factors that were leading into this kind of a re-rating? The commentary that we've gotten from banks this earnings season, mid-tier banks, large banks, is the big growth that is expected in credit offtake for the rest of the year.
Actually, for the last 2-3 quarters, things have started stabilizing. The impact of COVID was by and large over. We in fact discussed about that along with our fourth quarter results. Only uncertain thing that was coming along with the fourth quarter results was that how the inflation will pan out, particularly because of the higher oil prices, because of Ukraine-Russian war and things like that. But after 2-3 months into that, along with our first quarter, we felt that the impact was by and large observed, and we don't anticipate much problem because of that, which in fact increased the confidence in saying, like say, a few extra percentage growth, which we expect for the current year. Because at the beginning of the year, we said we expect the growth rate at lower teens. But after that, 2-3 months into this year, we felt we could even have mid to maybe about, let's say, more than mid-teens sort of, which when, let's say, in fact was almost reached the expectation from the entire banking system per se. And for the last 2-3 quarters, the total slippage to NPA, the gap between total slippage into NPA and recoveries from both the live accounts and technical written-off accounts have got narrowed, which is also giving probably the good outlook for the asset quality for the current year.
Okay. At what rate is your deposit franchise growing?
See, basically last year we had about, even the last quarter we said we had about 11% growth in advances and about 9% growth in deposits. We have, let's say, surplus funds to that extent for another about 2,500 odd crore incremental advances. We may not require incremental deposits because of the surplus liquidity available. And we had always positioned ourselves as the asset-driven bank, and we try to grow our deposits in tune with the expectation of the credit. We don't anticipate deposit growth to be an impediment for the credit growth rate. Things are balanced at this point of time.
So if the credit growth is ahead of the deposit growth, or if the deposit growth is lagging the credit growth, how would you then match your credit growth requirement? At what point in time you'll have to raise capital?
See, the capital raising is not on the cards for the immediate future, because already we have close to 20% capital adequacy ratio with almost 19.5% from the Tier 1 alone. As I told you, we have currently, let's say, never ever you will have deposits rate and advance rate equally matching and all. So depending upon which part of the economic cycle you are in, which part of interest rate cycle you are in, there will be a lead and lag between the deposit growth and advance growth. As I told you, there was higher deposit growth in the last couple of years, and hence there is a surplus money available with us. And for another almost 60-70% of the expected growth for the current year, existing deposits surplus funds itself will be sufficient to take care of the growth, and other options like refinancing and all are always available, and we don't expect deposit growth to be an impediment for the credit growth.
I've looked at I've tracked City Union Bank for almost a decade now, and it's outstanding the kind of shareholder wealth what you've created. But some would argue and say that given the trend in this decade, which is that big banks are getting bigger and smaller banks are getting marginalized, how would you defend that?
This question I am facing almost for the past 2 decades since I joined the bank. And during this period, in fact, our market share has, in fact, even it could be a smaller one, but it has doubled. We had always seen that our growth had outperformed the industry growth by a couple of basis points on a continuous basis. And we don't see any major thing because of that. And we expect this. We may not be the third largest bank or fourth largest bank. We have always positioned ourselves as the efficient and profitable banks measured by the ratios of ROAs, ROAs, cost income ratio and things like that. And growth has also been just over and above the growth rate of the industries. And we don't feel any threat to this existence as long as we are adding value to all the stakeholders, particularly the customers, on which we don't see any issue.
Okay. So just to wrap it up in terms of term loan versus working capital loan, where are you seeing inflection point?
We have always had a broader pattern of leaving the non-gold loans about close to 2/3, 60 to 65% from the working capital and remaining 1/3 from the term loans. We had always positioned ourselves that, like say, we try to be the sole bank with the total control over the assets and the cash flows of the borrower. We don't anticipate any major change to this strategy, which has helped us to carve out a niche and so that keeping us to greater extent insulated from the fluctuations in the fortunes of the market. So we feel we continuing with the same strategy for near future.
Mr. Kamakodi, really appreciate your time. Good luck. And I certainly hope to see much more of you going forward on the channel.
Thank you. My pleasure.